Arista Networks just delivered its first ever $3 billion quarter. Revenue was $3.036 billion, up 37.7% year over year and above the company's own $2.8 billion guidance. Non-GAAP earnings per share came in at $1.02, up 40%, ahead of expectations. For perspective, 5 years ago, in 2021, Arista's entire year was $2.9 billion. Now, it does that in a single quarter. If Caterpillar is the power half of the AI data center picks and shovels trade, Arista is the networking half. Inside a data center, tens of thousands of GPUs have to be wired together with switches and fiber before they can train a single large model. What Arista sells is that high-speed Ethernet fabric. Its AI networking line, Etherlink, has now passed 100 cumulative customers, up from just 4 or 5 back in 2024. The more important signal is the guidance. Arista raised its full year 2026 revenue outlook for the third time this year to about $12.6 billion, roughly 40% annual growth. That number is $2.1 billion above the $10.5 billion given at the Analyst Day and $1.1 billion above the $11.5 billion projected in May. Management was clear that the raise is broad-based, not just AI, but the core data center front-end, campus, and routing as well. But what gives the raise its weight is not demand, it's supply. Arista's multi-year purchase commitments have nearly tripled in a year, from $3.6 billion to about $9.7 billion. Memory supply is locked for 2026 with visibility into 2027, and the company has stood up a dedicated liquid cooling supply chain for the next generation of AI. The CEO put it bluntly on the call. Don't think we waved a magic wand and the problem went away. The industry has a 2-year problem and won't get out of it until around 2028. In other words, what constrains Arista right now is whether it can get enough chips and memory, not whether it has orders. There's one crack in this report, and it is gross margin. Non-GAAP gross margin was 63.4%, down 2.2 points from 65.6% a year ago. The reason is a rising mix of hyperscale customers. These large buyers order in volume and negotiate hard, and that pushes the margin down. Sequentially, margin actually recovered a bit from 62.4% last quarter, but management admitted 20 to 30 basis points of that was a tariff refund. The rest was customer mix, and there is no pricing benefit yet. That won't show up until the end of the year or into next year. Arista held the other side with scale. Non-GAAP operating margin hit 49.9%, a record, with sales and marketing at just 3.6% of revenue. In short, it is trading gross margin for volume and using scale to defend the operating line. The analyst questions circled 3 things. First, customer concentration. Arista confirmed Microsoft and Meta remain its 2 largest customers and expects to add 1, maybe 2, new 10% plus customers this year. Second, the white box threat. Management's answer. More and more customers want the full EOS operating system plus hardware stack, or a hybrid of open systems and EOS. Pure white box is left to the ultra cost-sensitive, or the titans with large in-house teams. Third, scale across, connecting across data centers. Management argues compute, space, and power will be permanently scarce, which makes cross-data center networking a durable demand, a $15 to $20 billion market by 2030. Put the quarter together, and Arista is sitting in about the best possible seat in the AI networking supercycle. 3 months from now, Q3 is the next check. The bar is already set. Revenue of about $3.3 billion, and EPS of 1.06 to 1.08. Watch 3 things. First, whether gross margin holds around 63%. Second, whether the core data center and routing businesses grow the way management promised beyond AI. Third, how much supply actually releases, which decides whether there is any upside left in the year. Get those 3 right, and Arista's AI networking story is truly confirmed.